So this one is quite a heavy topic. You must know what is bond, who are the people who invest in it and why they invest in it. You must know what are the basic bond features. Like example, coupon, which is usually fixed but can be floating. But majority of bonds are fixed coupon. Par value is the original amount that was issued, which will be different from the market value. We keep changing because interest rate is changing, right? But it will be the amount that will be paid back to the bond investor at the maturity date. Now there are three sections of your, in terms of maturity. So I want you to listen carefully. Money market is for very short maturity. So at the point of issue in a money market instrument, the maturity will not be longer than 1 year. Then if something, if the fixed income is security, but the maturity at the point of issue is more than 1 year, but say less than 10 years, it will be a note. It's called a note. Basically, they are bonds, but these are just a technical thing. Then for those that are issued at the point of issue, if it's like more than 10 years, it will be called bond. So that's a classic case of bonds. So most bonds will be like 20, 30 years at the point of issue. I think there was some country, some government, I remember issuing 100-year bond. That one definitely will never survive to collect the par value. Next generation. Now the types of bonds, we can differentiate by bonds by the way the coupon is paid, bearer bond. So this part was all e-learning, bearer bond, registered bond, floating rate bond, there was an example. Income bond, which is a very special case because we say that cannot postpone coupon, but income bond can, legally allowed to. And the zero coupon. Now zero coupon is quite an important type of bond to know. Now collateral is whether there is some asset backing as security for the bond, first mortgage, second mortgage, general mortgage. And some unusual thing about bonds is perpetual bond. Bond is supposed to have a fixed maturity, but perpetual bond has no maturity. So it's almost like I said, no maturity, but forever, but it's a fixed income coupon. And then the convertible will allow the issuer put it there because they want lower interest rate, but the investor can decide to change that convertible bond into share. But very few bonds are convertible. Very few bonds are perpetual. Now then we also learned that there are certain features, if it's present, it's not always present in some bonds, but there are some features, if it's present, it may affect the maturity of that bond. Like for example, call provision will allow the issuer to call back the bond early before the maturity. If it's to their advantage, like interest rate drop a lot. So they can issue a new bond with a much lower coupon and enjoy the interest saving. I think last year there was is it last year or the year before, there was a question on calculate the interest saving. And actually if you look at your lecture note, there is enough teaching inside there to do that. It's simply identify the interest saving, find the present value, that's all. So for those who present value are very good, should not be a problem. Present value not so good, then it's a problem. Now, sinking fund provision can potentially also reduce the maturity if you are using the core method. Every year buy back 10% after you put the sinking fund, and then every year buy back 10%. Then for those that were selected, they couldn't go until maturity. But if they use the deposit method, just leave the sinking fund in the bank, right? Then everybody's maturity will not be affected. Bond rating, okay. Bond rating was important because it tells us about the investment grade of the bond. Then after that, we move on to, there are 3 slides. But these are all black, right? I know you're waiting for red color, but these are all black now. But the second slide will have some red. Now, bond valuation and computing bond yield is an important area. In the e-lecture, I told you what causes interest rate to change. Interest rate is simply a required rate of return for a fixed income instrument. So, a required return is always dependent on 3 things. The real risk-free rate, RFR, the expected inflation, I, and the risk premium of that particular issue. either the asset or that particular issuer. Now then, when we talk about bond yields, is another way of doing your bond valuation. There are 5 of them. Nominal is just telling you what the coupon rate is, not useful for analysis. Current actually is useful for those who are income oriented. Like for example, that's why I tell you the 100-year, I'm at my age, if I buy a 100-year-old bond, I won't be looking at the yield to maturity because I will mature before the bond will mature. I won't get back the bond value. So I'll probably look at the income, right? But for most investors, they should be interested in the yield to maturity because they will be around to collect back the par value. So they want to know what is the total return to the yield to maturity. Now, in the case of a callable bond, then you won't be able to hold until maturity if it's call, right? Then we calculate the yield to call, right? Or if you have a targeted holding period that is less than maturity, then you have to estimate the selling price at the end of the holding period, but it won't be maturity, so it won't be par value. So you have to estimate, then again you can calculate your yield. So we need the interpolation. Now, because interest rate changes, one of the most significant risks for bond investor is interest rate changes, which will cause. I think this is nothing new, so if you are not interested, you don't have to be here. Now, I forgot what I was saying. Which could have been useful, but I've forgotten. So if you make noise to trade, you disturb my train of thought. Okay, there are 2 types of interest rate risk. It's because when interest rate changes, price of the bond will change. And it's inverse relationship. When interest rate go up, bond price drop. But the other risk comes from understanding your yield to maturity, that we only get the calculated yield if we reinvest all the interim cash flow at that calculated yield. Otherwise, our true rate will be lower. So that's called reinvestment risk. So when interest rate go up, bond price drop. But it's easier to reinvest when you receive coupon to get good rate of return. So actually, your reinvestment risk and your price risk is opposite. When interest rate go up, no good for price risk, but your reinvestment risk is much better, more easier to manage that. When the interest rate goes down, your price go up, so that's good, but your reinvestment risk become more severe. So it's opposite these 2 risks. How to manage? For a bond investor who is very worried about price risk, they should buy a bond which will mature at the time that they need the money. So they will choose a maturity to tie in with the period of time and say, hey, I'm investing now, but I will need this money in 10 years. They go and buy a 10-year bond and they intend to hold until maturity. Because at maturity, the price of the bond will definitely be par value. Or because of the legal requirement to pay back par value. Now, zero coupon does not have reinvestment risk because there are no interim cash flow, no coupon to be received, so there's nothing to reinvest, right? So if you want no risk at all, buy a zero coupon bond and hold to maturity. No reinvestment risk, no price risk, but the credit risk is the highest. Because we assume that the issuer will be around to pay us our par value. But actually a zero coupon is because after we buy, we don't receive any cash flow at all, not a single coupon. Your credit risk is the highest. Also, when you choose zero coupon, must choose properly. Make sure you're very comfortable with the credit risk. Okay. Yeah?
It's recording. Sideways, so how to
Okay. So this is the fixed income, the last slide. Actually, there's a lot to cover under bond price volatility, and it's one of the important things because even if we understand that interest rate changes will affect our bond price changes, we must know that not all bond price will change the same way, or the same percentage. That's why you need to understand bond price volatility. What's our bond, the change in price will be more volatile compared to other types. There will be some times when you want a more volatile bond. Like for example, if you think interest is going to drop, and all the bond prices are going up, you want to be able to select the one that will be more volatile, so that you make more. But when interest rate is going to go, so the interest rate go down, that's good. But when interest rate go up, usually for most of us, we don't want to buy bonds because we will lose. No matter which bond you buy, you will lose. But there are some fund investors that have to buy bonds because of regulation. So for those sides, they actually know they lose, they will choose to lose less. So they will choose the least volatile bond. Okay. To understand bond price volatility, we must go look at your lecture note, the 4 findings of McGill, which is about, the first one is very simple, interest rate and bond price are opposite. Then the next two is low coupon, high coupon, which is more volatile, long maturity and short maturity, which is more volatile. Then actually, the fourth one is that the volatility is diminishing as we lengthen maturity by diminishing. The volatility is diminishing, it's growing by diminishing, not at the same rate.
You should just take it for short period of time. The beginning or is
now let's say you expect interest rate to go up. This means bond price go up or down? Down. So the best thing is sell bond. That is the most sensible thing to do. But let's say I told you, because of regulation, some investors, like insurance company, they're receiving a lot of premium, they cannot see on cash. Regulation say at all times, how many percent of your premium must be invested in the bond market. So they have to buy bonds, right? So they say, okay, if bond price is going to go down, no matter which bond I buy, I'm going to lose. So they will say, or if have to buy bond with low bond price volatility, so that useless. Now let's say you look at these two bonds, A, B, coupon, maturity. Let's say coupon here 3.5%. This one 4%. Maturity, let's say this one 4 years. This one say 5 years. If you want long bond price volatility in terms of coupon, which one you prefer? A or B? You want a less volatile bond, which one do you want? A or B? You haven't studied yet, huh? Remember this, huh? Okay, I give the rule now, huh?
Less volatile, less coupon. Less volatile, less coupon. Less volatile, less coupon. What's lesser risk? I think.
If you want high volatility, right? In terms of coupon, choose a low coupon. Start with L. If you want maturity, choose the long maturity, start L. So this is the memory aid, huh? The 2L. Low coupon versus high coupon. Low coupon will be more volatile. Long maturity versus short maturity. The long maturity will be more volatile. So the 2L together will be the most volatile. But in this case, if we want low volatility, that means we will choose which one? We will choose high coupon. That means this one, right? 4% is higher than 3.5. Then if you want low volatility, you want a short maturity, so it will be this one. So that's a problem. a lot of time for the investor. Because when you look at coupon or maturity individually, we know how to select. But very often, the one that we want is in two different bonds. And we need to have a way of doing it. That's why we need this thing called Macquarie duration. Because Macquarie duration combine these two together to calculate Macquarie duration. Okay, my number is not accurate. I just throw any figure. Let's say that it is this one is 3.8 years of duration. This one is let's say it's 4.1 year of duration, just for example. Then of course this one will be longer than this. Then this one will be not so volatile. So these are low coupon, long maturity, or long duration. If you want high, all the three L's. Make it easier to remember, right? All the three L's are the most volatile bond. In terms of coupon, L, low. In terms of maturity, long, L. In terms of Macquarie duration, L, long. All the three L's. That way you don't have to be confused. Right? Most volatile. But in this case, the one I wanted is actually the not so volatile. So it will be all the different one are short. So high, short, short. Low coupon, long maturity, long Macquarie duration will give you the most volatile one. Now, I would suggest you practice this from the past 2 years. Now, I'm not going to go through the answer, but I want to highlight certain things. For 2016 question 2B, right? This was a 10-mark question, asked you to calculate Macquarie duration. So listen carefully. Usually we will give the column heading, so that it's easier for you. But what you need to pay attention is read. Is the coupon annual or semi-annual? Because each period, under the time here, right, one row is one period. One row is one period. So in this case, if it is 5 years remaining to maturity, and this is annual coupon, I only expect to see 5 rows. But if this is semi-annual, I expect to see 10 rows. So read carefully. Read carefully. Now, then everything must be consistent. Listen carefully. If this is semi-annual, the cash flow must be half a year's cash flow, not the 2 years cash flow. That means half the year, because the coupon for the whole year is divided into 2 months. So each period will be only half of the year's coupon. So in this case, what the coupon? 5,008% is, okay, 8% times 5 will be 400 lah. But if it's semi-annual, it will be 200. But if it's annual, it will be only one cash flow of 400. So these are the things that you need to be very consistent. Read this type of thing. Is it annual cash flow or semi-annual? Right? Now, then the discount factor must be consistent with the period. Is it a half a year or a full year? So the discount is your yield to maturity here given 7%. If it is annual, then the discount factor is based on 7% per annum. But if the semi-annual, then this 7% has to divide by 2 to be 3.5% per period, which is half a year. So just be consistent. And then the rest, I think, you should not have a consideration. Right? Now, the answers for the past 2 year paper will be on LMS on Monday 11 at 6 p.m. because I will finish my review here around 6 p.m. And since I'm using this, I want them to practice, so I rather not show you that. By 6 p.m. Monday, right? All answers for the 2 year paper will be there for you to have it. But I would suggest you also practice rather than look at answer. Usually if you look at answer, you think you know how to do it. And sometimes that's a false assumption. It's better to do without looking at answer. Even if you print answer, don't look at it yet. Go practice first. Then you check. If you can get it, you should be confident. If you cannot, better see that. Okay.
But yeah, I know she will answer. She always answer and see it already. Okay,
so actually this is the answer. Huh? Now listen. So whatever you're calculating, we always end up with period first because how many periods here, right? But the final answer for Macquarie duration must be years. So this one you realize period and years the same because it's the annual coupon, right? But if it's semi-annual coupon, it will be 200, 200. Then what you end up here will be probably about 8 point something period, right? But it's only a 5-year maturity. How can it be more than that? Right? So you remember to convert back to years. These are just some of the finer things you should pay attention to. So bonds, any question? No, huh? Okay. Now security valuation. Listen, three major areas, a generic idea of valuation, so the theory of valuation or the basic concept is to, basically in all valuation purpose, when we're putting out absolute dollar amount for valuation, right, it's always present value of the future cash flow. So the variables that you need will be identify what is the cash flow in the future, each period, discount to present value, because we are making the investment decision to buy and sell at the current price. We need to know what's the value now, so it should be present value of those future cash flow. So obviously the time period is important when you're doing a discounting. Now, in your tutorial question for security valuation, we actually look at what cost. For example, hey, why Singapore bonds and Singapore shares should have different recovery or return. Every time when you're looking at this question, always think in terms of the three things: risk-free rate, inflation, risk premium. Actually, for Singapore share, Singapore bond, the only difference is the risk premium, because the risk-free rate is about the economic growth in Singapore. So whether it's bond or whether it's share or property in Singapore, it will be the same. Expected inflation, again, there's only one inflation rate for the whole country. So what makes it different is the risk premium is different. But when you look at a different country like US versus Sing, then all the three are different. Okay? Now for the dividend discount model, which is the main focus for FOI, or stock valuation, we revise your no growth and your constant growth, which was from business finance. But what's more important is your 2 or more stage dividend discount model. And if you look at some, okay, this one I will tell you, the earnings multiplier will be the lesser of the two methods. That means it's not important. Dividend discount model will be more important. But it is quite often tested in MCQ. So you still need to know what are the factors that causes why the PE higher, lower, that sort of thing. Look at the past 2-year paper. You will see, for example. Now, when you look at the past year paper, if you see certain things like that, that means actually for this year, this part of the syllabus has been removed. So you don't worry about that, But I realized somebody told me, they don't have the current share price when they did this part. But the share price is given here in Australian. So I may have to go and adjust that part so that you can see the share price. Because you cannot calculate without the share price. But at least I know somebody is trying. Now, so this one example of a two-stage growth, right? In fact, this one is how many stage? 20% growth for 2 years, and then another 10% growth for another 2 years, then after that long term. So for the long term sustainable growth, when you can use the Gordon formula, you have to look for language like that, like long term sustainable constant growth or something like that. So that means actually, remember the basic principle about the two stages is only the Gordon shortcut can only be used for the last stage when the growth is forever at the same rate you see. All the earlier stages, you can calculate whatever the dividend is and no choice of just individually deciding. Even if there are two different types of supernormal, it doesn't matter, since they are not shortcut. Okay? On the other hand, your constant growth, right? That formula of P0 equals to V1 divided by K minus G can be obviously applied for the dividend 5, which is the first of the division under constant growth, right? Can also be used for year 10 one. Because from year 5 onward is constant growth. Wouldn't year 10 also be constant growth? So the P0 equals to V1 K minus G, that concept can be applied anywhere along the life of the stock, as long as it's constant growth still. So are you listening beside watching my slide? Because you are, then you will benefit. Okay, any question on security valuation? If not, let's go on to options and warrants. So only let this topic and futures and a bit of new trend that's on. Now, under options and warrants, there will be this one got 4 pages of slides. Derivative, I started with telling you that you can use it in a safe way, which is hedging, or in a very high risk, high return, risky way, which is leverage trading. Right? Now, I started with option, right? But you notice in my revision lecture, I'm telling you, option and warrant is the same thing. That's why I say option warrant, holder has right but no obligation. All this will apply. Right? It's important to know which option you should select. So if you are bullish, you should select a call option or call warrant, because the right to buy at a fixed exercise price is very valuable, because bullish means that you think the underlying share price will keep going up. So your intrinsic value will become more and more and more. But if you are bearish, you think the underlying share price is going to drop a lot, then a put option will be more useful. So that you can sell at a fixed price. So no matter how low the share go, you can go and buy the share at a very low price and then exercise to sell at a high exercise price to make more profit. Also know there's a difference between European and American. Which one can only exercise on expiry date? Okay, very good. European. American, you can exercise anytime you want. Of course, not after expiry of this year. Now, in the money means it is profitable to exercise. And the money is break even. Out of money is if you exercise, you will lose money. So the holder will, since they have the right to decide, they will never exercise an out of money option. Remember, to decide whether to be profitable to exercise, ignore the option price paid. That means the concept of in the money, add the money, out of money, don't care what is your option price. But when you ultimately calculate your net profit and loss, right, you must bring it in. Remember the payout diagram? You say, hey, how come I don't exercise, I still got loss? Now you pay for the option price, of course that's your loss. Now, for option or warrant pricing, pay attention to the terminology. Option premium is option price. For warrant premium is not warrant price. Warrant premium is only the time value part, that means the speculative part of the warrant price. But basically, whatever is option premium or warrant price is broken into two parts: intrinsic value plus time value. Intrinsic value is very easy to calculate. It's the difference between the exercise price and the changing share price. Okay? But no negative intrinsic value because you have the right to decide whether to exercise. So you will never exercise to lose money. So the worst case is don't exercise, so no losses, minimum is 0. Then the balance between the option price and the intrinsic value is your speculative value. Now, so you will see things like speculative value, time value, or in the case of warrant premium, they all mean the same thing. Right? In the case of strike price or exercise price, they also mean the same thing. These are interchangeable terms. Now, one of the more important concepts is this thing called gearing ratio. So you remember, gearing ratio is the initial share price divided by the initial option price. But listen carefully. If the exercise ratio is one option or one warrant is one share, you just do that, that'll be okay. If it's not, you must adjust. That means let's say for example the tutorial question, we had 5 warrants required to exercise the one share right. So if on top you put the initial price for one share right, the bottom must be equivalent to that one share. That means 5 warrant right. So you say what's the warrant price, then times 5. So that is equivalent. Or you can do one warrant, then the share will be only 1/5 of the share price. It's the same, mathematically it will be the same. Right? So pay attention to things like that. Because in fact, most often in the market, the option or warrant is not one. I only introduced the warrant part because it was a difficult concept, so I thought I brought you to 1:1 first until you understand that the last part then I bring in the more realistic one, which is not, usually it's not 1:1. Okay? Anyway, look at the past year paper, you'll see. I'll go practice. Okay, there are 6 factors that will affect your option or warrant pricing. 2 of them, which is your current share price and the exercise price, will affect your intrinsic value. The remaining 4 is affecting your speculative or time value. So you need to know how to explain some of them. I don't know which one. There are 4 basic trading strategies. Either long is buy or short is sell. So either long call, short call, long put, short put. We actually learn how to do the payout diagram. It's in your lecture note. Then the last bit of the topic, we brought in your warrants. You say that actually in Singapore, if you go to SGX, you won't find any option, but they are there. They are called warrants. And in Singapore, if you go to the SGX, the warrants are either issued by the company itself, that means the underlying share right, that company that actually is the one that issued the share is also issuing the warrants, that means it's a capital raising exercise. But most of the warrants are the other type, structured or covered, which is the option that we're talking about. So the bank will just introduce for people to trade. So the type in your e-learning, by the way, for the e-learning, a lot of the answers I received are wrong. I already uploaded the correct answer. I advise you go and have a look. So the whole semester, actually if you have been following the whole semester smoothly, right, then it's quite okay. If not, you have to go and do a lot of catching up now. Or just try to pass. If you don't want to score, then just try to pass. I would suggest you try all this. Oh, sorry. Yes. Huh? This one. Is that? You bought it? Yes. Is that okay, huh? Okay, any question you want to ask me about options and warrant? Alright. Then the last major instrument was futures. This one there is 2 slides. So after this, another one more slide. Now, so we learned what is a futures, right? Unlike your option, there is no right. It's an obligation for both buyer and seller. And you can get exposure to the same asset either in the spot market or future. The main difference is this, listen, the main difference is this. If you want your exposure through the spot market, you must do your settlement immediately. I say T plus 3, T plus 2, that sort of thing. But if you don't want to settle immediately, you can get the same exposure by using futures. Then the settlement is like 3 months later. But you have to pay the deposit first. Because it's an exchange traded product, the exchange want you to put a deposit first. Because one party will lose one. Since it's an obligation on both sides, one party will lose money. Huh? Now, last week we did the bond futures in your tutorial, so you realize the standardized size for bond, the bond as well as the bond, the bond future is based on par value. For stock, for stock, right? This week we did the stock. The standardized value is how much, dollar amount per index coin. Okay, the more important thing is know how to use futures. Which is either a long hedge. Okay, the thinking for hedging is like that. You think you're going to suffer a spot market position loss, opportunity loss, because you can't do something in the spot market now. You have to wait a few months to. So to cancel that loss, you must go to the future market with the intention to make profit. But the price of the two markets will move up and down together. So this is the principle to decide whether it's a long hedge or short hedge. If you are afraid of the price of the asset going down, you see the price is now high, both in the spot and the futures market. To make a profit is always buy if it's low, sell if it's high. So if it's high now, sell futures, it will be a short hedge. But if you don't have a spot market position, which is a speculation, then that one is depend on your view. That one can be very wrong or very right. But the moment you go into a hedge, you don't care, you'll be okay one. It will always be one profit, one loss, except that it may not be happening in the market you thought you were, but the two will cancel. As much as possible. The best hedge will be zero profit and loss between the two markets, but very difficult to achieve, as you noticed this past 2 weeks in the tutorial. Speculation is a very risky way of using futures, but if you are right, you will have leverage return. Now the limitation, that means why is it you can't get a perfect hedge, is because you have to do in standardized size. So it may not match exactly the volume that you need in your spot market. And also the direction or change in the price is the same, but the percentage change will not be the same. So sometimes you will not get perfect. The profit and the